It turns out that the majority of day traders lose money and are not profitable. Well, why is that? It's because day traders need to know a lot of different things to be successful. For example, they need to know when to buy a stock, when to sell a winner when a stock is going up, when to sell a loser when a stock is going down, how many shares to trade, when to trade and when not to trade, how to design a profitable strategy, how to find a profitable strategy, which stocks to trade, and more. So this is complicated. This is not easy. This is not something you can just walk into and 10 minutes later you're going to be wildly successful. So let's talk about the 5 reasons why day traders don't succeed. And the number one reason is that they take on too much risk. They trade too many shares and they blow out their accounts at some point. Okay. Now, what happens is, for example, let's say you have $10,000 in an account and you risk $1,000 per trade. That's way too much because first off, you're going to be losing more than you're winning in the beginning while you learn. So you should be trading, very small, like maybe 100 shares per trade. The second thing is that's taking out too much capital out of your account in any losing trade. The idea is to kind of be like a casino. We want to trade with the odds in our favor and do lots of small trades because there will be times when you have 3 or 4 or 5 losing trades in a row, even on a good long-term profitable winning strategy. So you need to know that you're going to make money and not be wiped out if you have a losing streak. Okay. Now the second reason is psychology. People, their minds get in the way sometimes. They may not be disciplined. They're not patient to wait for entry and exit points. They're not following their trading plan. They're letting emotions interfere with their trading. I just listened to the great trader Larry Williams, and he talked about how he watches more than he trades. He waits for the right trades, and then when everything is right, then he places a trade. So we need to be like that. Even though we want to trade, we need to look for those setups that follow our trading plan, where we know we have an edge and the odds are in our favor. Okay, so we want to create a good plan and then follow it. The third reason why day traders don't succeed is that they don't have a trading plan in the first place that has an edge, or if they do, they're not following it. A good trading plan shows you situations where stocks do something in certain situations. For example, stocks have a tendency, if they're going up, to pull back around 10 a.m. So you could, based on that information, see how much a stock pulls back, when it tends to pull back relative to 10 o'clock. Is it a little early or is it a little late? Does that mean that the stock is strong and is likely to go back up? Or if it comes back late, is it weak? Looking at things and seeing how the strategy works. Or you could design a pullback strategy rather than a reversal strategy if you prefer. That means you would look at the charts, determine a good entry signal, and then determine where to put profit targets and stops. This is all part of designing a good strategy. Okay, finding those situations where stocks have a tendency to do something and then trade a strategy based on that edge. And there are many different strategies that you can choose from. Okay, another one is letting your losses run. Now, this is the classic error of rationalizing after the stock hits your stop, but not getting out. That's why I prefer that students and new traders put the stop manually in the software once they learn how to do that. You can do it manually, but you're more likely to justify it or rationalize it if it hits that point and then it gets worse. So I prefer you don't do that. Learn to take a small loss, or eventually you'll have to take a large loss. And that's what we're trying to avoid. Small losses is part of the game. Large losses aren't. But the reverse of that is putting stops way too close. So it's natural for new traders and for everyone actually to not want to take a loss. But most new traders tend to put the stops like way too close, like 2 or 3 cents away. That's too close. Usually you need to give a stock wiggle room, which means that it's room for the stock. That doesn't necessarily mean a change in direction, but the stock is just normal wiggles. For some stocks, it might be a quarter. For other stocks, it might be 2 or 3 cents. Depends on the price of your stock and how volatile it is. So you should know how much wiggle room to give your stock and give it a little more room to put your stop loss based on that. So the natural tendency for all new traders is to put their stops way too close. Just be aware of that. So those are the top 5 reasons why day traders don't succeed, and I hope that helps you. This is Greg Kilpack, and I'm with Trader to Be.